Hello everyone and welcome to this video. This video is going to be about dollar cost averaging, and more than understanding the traditional definition, I was really interested to create this video because I use dollar cost averaging in a slightly different way, which is my technique of using this concept, and the results that I get are much better than you get by using dollar cost averaging. So if you want to understand my technique and how it is better than the regular or the traditional dollar cost averaging technique, watch this video to the end, and I'm sure this will improve your trading results and investment results significantly. So this is what we'll cover today. We'll look at the traditional definition of dollar cost averaging. We'll look at the general advantage of dollar cost averaging, and then I'll discuss my specific way of dollar cost averaging and how it improves the trading and investment results. And also, I will um, call out the essential requirements that have to be met when you're dollar cost averaging. If you just pick up any scenario, any market condition, any stock and start dollar cost averaging, you can end up losing a lot of money. So those pitfalls must be avoided, and dollar cost averaging should be used only in specific cases where it can actually give you really good results and returns. A quick look at the disclaimer, which basically states that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please get in touch with a certified financial advisor and understand the risks carefully before investing your money. A quick call out that I'm sharing the trades that I take on the community tab of my channel. So if you want to follow my trades, all you have to do is subscribe to the channel, enable the notifications. Once you do that, as soon as I post a trade on the community tab, you will get a notification, and then you can go and see the trade, and that forms a really good learning experience. A lot of similar services are out there which share their trades, and those trades may not even be profitable on a consistent basis, and these are all paid services. Right now I'm offering this particular service, that is, I'm sharing my trades free of cost, so definitely check it out.
In order to get my trades for free, you can just go to my channel, Serene Trading Strategy, and once you're on the channel homepage, then you can go to the community tab over here, and here you can see that all trades are listed. So till now I have posted 41 trades, and some of these will show in the open status, which means this is an active trade and I have still not closed this particular trade, whereas some trades you will see will be closed. So these are older trades which have been, these positions have been closed, and so we have multiple open and closed trades mentioned here on various symbols that I have taken. And also for the closed trades, what was the return, whether it was a profitable trade or a losing trade, what was the annualized return, how many days were there to expiry when I took the trade, and actually the trade was open for how many days, all those statistics are mentioned here. We also keep a track of the running loss or profit. So right now you can see this is a positive number, so there is a $4,052 profit till now. So if you want to follow my trades, you can follow this process, and hopefully you will find this helpful.
So let us first understand, in the traditional sense, what is dollar cost averaging, and instead of just talking about it, I'll take you to a chart, and there we'll see how dollar cost averaging actually works. So let's go to the stock chart. Okay, so here I am on the Finvest platform, and for those of you who are not familiar with this platform, you can check the Finvest playlist on my channel. I'll leave a link in the description, and that basically will give you an idea as to what this platform is all about. And if you want to look at the different screeners and the settings that I use, you can take a look at that. But I'm using this just to help understand the chart. So as you can see here, I have opened Microsoft chart over here, and this is a monthly chart, so we can look at the data right from 2012 all the way to 2022. And the reason is because I want to explain what is dollar cost averaging in the long run. So as you can see here, that every bar here represents 1 month, because this is a monthly chart. So the overall trend of this stock has been in an uptrend. We can see that, and from 2022 it has taken a pretty big dive. But otherwise, if you see, this stock has been in overall uptrend. So this is the very concept. This is the basis of the concept of dollar cost averaging. That in the long run, the stock market, it actually moves to the upside. So the main problem that any investor has is that they don't know what is the right price to buy at. So what dollar cost averaging says is that every few months or at a given regular interval, you just keep buying shares at whatever price is there in the market at the time. For example, for somebody who starts with dollar cost averaging on Microsoft in 2012, they would buy with the same amount, they would buy shares. So let's say the person decides that every year I'm going to put $1,000 into Microsoft. So in 2012, at a price of $24, the first purchase would be done for $1,000. Remember, every interval, the amount being invested will always be the same. So the concept here is that at $1,000, if you invest $1,000 in Microsoft at a price of $24, then you get a certain number of shares. Now, 1 year later, the price can go up or the price of the stock can come down, but you still invest another $1,000. And what that does is that it will give, if the price has come down, then you'll buy an even larger number of shares, and if the price has gone up, then you'll buy a lesser number of shares. So, not to just explain that concept, I'll go to the weekly chart, which shows more price variations. Yeah, so in this case, let's say, just to understand the concept, that the investment is being done on a monthly basis and the monthly investment is $100. So what will happen is, here in this month, the purchase would be made for $100 when the stock price is at $179. So roughly 5 point something shares would be bought. Now next month the price has gone slightly up here, so the price is trading around 200 plus, so you'll get slightly less than uh, 5 shares. Oh, sorry, my calculation is for $1,000. So let's assume every month $1,000 are being put up just to understand the concept. So here, 5 point something shares were bought, and in this month, slightly less than or almost equal to 5 shares will be purchased. And you can see as the price goes up, so every month you will keep adding more and more shares. But by the time you reach this month, right, you will hardly get 3 shares for the same $1,000 being invested. So when the prices are low, more shares are being added. When the prices are high, then lesser number of shares are being added. The invested amount is remaining the same. And if you look at all these months taken together, what you will realize is that some shares were bought at a lower price, some were bought at a higher price. So this is the concept of dollar cost averaging, that you're buying some at a low price, some at a high price. But in the long run, what is going to happen is the ones that you bought at a low price will eventually go above that buy price, because the overall long term trend of the market is bullish. It is in the towards the upside. So this is the very concept of dollar cost averaging, that you keep buying shares whether the prices are going up or going down, and eventually in the long term you will be profitable, because even those shares that you have bought at relatively higher prices today, those higher prices will become low prices 5 to 10 years from now, when the stock would be trading at a much higher price. So this is the traditional concept of dollar cost averaging. Now I'll also cover one more concept here itself, that what is the biggest benefit, and there are multiple benefits, but I feel that there is just one really significant benefit of dollar cost averaging, and that is what the name suggests, that you reduce your price of holding the shares. Because in a downward market, let's say you bought certain shares at $100, then in order to make a profit, the price has to be 100 or above 100. If the price, let's say, goes to 50, the stock may take a lot of time to come back from 50 to $100, because it has to double itself in price, right? So if you buy more shares at 50 at the same number, let's say, your average price will become somewhere between 70 75. And in this case, there is a very good chance that within the next couple of years the stock will go above 70 $75, so your overall position will become profitable. So that is one thing. And also for people who lack discipline, who can have a tendency of not investing regularly and spending all their money, dollar cost averaging is a very good technique, because it forces you, it disciplines you to invest money into the markets on a regular basis. So you will automatically allocate that money to the investment, and you will not end up spending it. A perfect example of dollar cost averaging is 401ks. So you keep contributing to the 401ks and keep investing in different portfolios. And what that does is, eventually over a 20-30 year period, you've bought something at low price, something at a higher price. But those low prices and higher prices don't matter in the long run, because in the long run, as you can see here, somebody who bought at 24 or 50 or 60 or 80 or 90, doesn't matter really, because 10, 20 years down the line, the stock is trading at 300, close to $300, which is way above than all these buy prices, right? So this is the concept of dollar cost averaging, and it is extremely useful for people who lack discipline to invest their money on a regular basis. Now I will get to the very interesting concept as to how I use dollar cost averaging. So I use dollar cost averaging pretty much the same way that it is defined in the traditional sense, but with one major difference. I do not dollar cost average when the price of a stock is going up. I dollar cost average only when two conditions are met. One, the price of the stock is below its intrinsic value as per my calculation. And secondly, the price of the stock should be going down. I don't dollar cost average when the price is going up. So, what does that mean? Let me help you understand with an example. Let's say that we have Microsoft here. So, I'll take Microsoft's example. And this is just an example, these are not exact numbers. So, let's say today I decide to start dollar cost averaging on Microsoft. But Microsoft right now, as we can see, is trading around $255. So first thing I will check is this price below my intrinsic value calculation of Microsoft or not? So first of all, I need to make sure that the stock is cheap. That means it is trading below its intrinsic value. So I'll just take another example here. I'm just taking an assumption here. Let's say my intrinsic value calculation of Microsoft is $300. So 255 is below that. That means my first condition is met. Only because the stock is trading below its intrinsic value, I will think about investing in that stock. I will not invest in a stock which is overvalued or which is overpriced. This is the first principle of value investing, which I make sure that I follow. Dollar cost averaging or any other way of managing money, risk management will not help you if you're not investing in the stocks at the right time, at the right price. If you buy something which is too expensive, then you've already started on the wrong foot, and now you're expecting it to become even more expensive to give you any kinds of profits or returns. I don't want to believe in that. I want to buy something which is cheap. Something which is cheap can definitely have a much better chance of reaching its intrinsic value at a later time or even going above that, and so my profits have much higher probability than buying a stock which is already very, very expensive. So first condition, as I told you, I will think about investing in Microsoft even with dollar cost averaging, uh, only if it is below the intrinsic value calculation that I come up with. Second thing is that, let's say I bought shares at 250 now, and the price starts going up. So it goes to 260, 270, 280, 290, and at all these prices, one thing is clear, that it is still below the intrinsic value, but I will not be adding to my position. The reason is I have already made an initial investment and that has become profitable, so I'm happy with that. I can find more trading opportunities, or I can find a trading opportunity within Microsoft itself, but at a later time. So I do not dollar cost average as the prices are going up. Another thing that can happen is, let's say Microsoft was trading at 255 and now the price of this stock falls to $200. That is the time when I get into dollar cost averaging. Why? Because my first condition is still being met, the stock is undervalued, and the second thing is, when I was willing to buy the stock at 250 bucks, 200 is a much more attractive price for me. So I would not dollar cost average even at 240 or 230 because that's a minimal drop in price. But if I buy another lot at $200, then this is going to bring down my average cost by a significant amount. So the second rule is that I dollar cost average only when the price has gone even below my first purchase price and it has gone down by a significant amount, by about 20-25% at least, so that if I dollar cost average at the new price, then my overall position is now cheaper by at least 15 to 20% as compared to my original buy price. You have to understand that if I invest the same money at $250 and if I invest the same money at $200, I'm going to be buying a much higher number of shares in the second go. And so these two positions combined together will give me a reduction in the overall cost basis by about 15% or so. And that is the important key thing to understand, that you're already in the first attempt, you bought something which was undervalued, and with the second attempt, you've made that cheaper by another 10, 15, 20% based on whatever scenario is applicable. So this is my way of dollar cost averaging. If you have any doubts about it, you can let me know, then I can show you specific examples where I have used this concept in order to continuously lower my cost basis. And lastly, I just wanted to call out some of the important and extremely essential conditions that should be met when you're dollar cost averaging. So, first thing is that never ever dollar cost average on companies which have a chance of going bankrupt. So, let's go back to the slides and we can cover the rest of the topics there. So this is what I was talking about, that you should make sure that you are never dollar cost averaging on companies which have a chance of going bankrupt. And the primary reason for any company to go bankrupt will be that it gets into an insolvency position or a liquidity crunch. That means be very careful when you look at the balance sheet of the company as to how much debt the company is holding on the balance sheet. Understand that whenever a company has debt on their balance sheet, then they need to make those interest payments irrespective of whether they have a good market condition or not, whether they are making money or not. So it's a debt is like a loan payment which you have to make irrespective of whether your income is there or not. The bank or the institution which has loaned to the company is not going to wait for their market conditions to improve or any other things to happen. They will expect the payout, the interest payout, and if that doesn't happen, the company needs to eventually file for a bankruptcy. So make sure that you're only dollar cost averaging on companies which have no chance of going bankrupt. That's why I chose the example of Microsoft, because they have a very, very strong and very, very healthy business. They have a very, very strong balance sheet. So this kind of a company, if you dollar cost average on it, it makes perfect sense. But for a company which is losing its price, which is below its intrinsic value, but has a risk of going bankrupt, then dollar cost averaging means you're putting more money after bad money. You've already made an investment and the stock has gone down in value, and you're putting more money in that investment, and the stock can eventually go to zero. Dollar cost averaging will only make sense if there is no chance, or you're 99.99% sure that the company is not going to go eventually to zero. So if you see the slightest chance that the company can go to bankruptcy, please do not use dollar cost averaging there. Rather, you should make sure that you invest a minimal amount of money there, and be contented with that, because you do not want to put your investment into a place where there is the slightest risk of losing your initial capital itself. The second rule is that your risk management rule for allocation should never be broken, even when you're dollar cost averaging. So I'll give an example around this. Let's say I follow a rule that whatever capital I have, I will never invest more than 5% of the capital in a single position. So that means, let's say I have $100,000. I'm making sure that in one stock, I will not be risking more than $5,000 at any given time. So the maximum loss I can have on a single stock is just $5,000. Even when you're dollar cost averaging, you have to make sure that these percentages are not broken. So your first investment, let's say you already have 19 positions, so $95,000 of your 100,000 portfolio is already invested. You're looking to invest another $5,000 now. So for that, if you pick up Microsoft, based on the example that I took, your first investment, your first purchase can be only for $2,500. Now, if the price starts going up, then fine, you just stay with that position and enjoy the profits. But if the price starts falling down, then you can take a second position of $2,500 again, and that will give you more number of shares and lower your overall cost basis. But do not exceed this position by $5,000, because if you do that, then your overall risk management strategy, which is to limit the exposure or risk in one particular stock to 5% of your overall capital, is not being met anymore. So then, even if Microsoft price falls further, you should not be investing more money. Overall risk management is way more important than individual stock dollar cost averaging. So I hope the overall concept of dollar cost averaging is clear to everyone. And if you have any doubts or comments around this, you can always leave a comment and I will respond to you. So that's the end of this video. I hope this video was interesting and it really helps you in improving your trading and investment results. If you have any queries, leave them down in the comments. If you like the video, please like the video and subscribe to the channel and share this with your family and friends. And I'll catch you guys in the next video. Thank you for your time.